Saving money is a crucial aspect of financial well-being, yet the approach to saving varies significantly depending on your age and life stage. As we progress through different phases of life, our financial responsibilities, goals, and challenges evolve, requiring us to adjust our saving strategies accordingly. What might seem like a modest savings goal in your 20s could be vastly different from the more substantial requirements of your 50s or 60s. Understanding how much money you should have saved at each age is essential for building a secure financial future. This knowledge not only helps set realistic savings targets, but also provides a roadmap for navigating the complex financial decisions that arise throughout life. Having a clear savings plan tailored to your age group can significantly impact your financial stability and peace of mind. In this video, we will guide you through the recommended savings benchmarks for every age group, offering practical advice on how to achieve these goals. By the end, you'll have a better understanding of where you should be financially and the steps you can take to stay on track, regardless of where you currently stand. Before we dive in, I encourage you to drop a comment saying, "I am in control of my financial destiny." Positive affirmations attract good things into our lives, so comment, "I am in control of my financial destiny." When I see your comment, I'll give it a heart. Now let's continue. In your 20s, one of the most important financial goals is to establish an emergency fund. This fund serves as a financial safety net, providing you with a cushion to cover unexpected expenses, such as medical bills, car repairs, or even a sudden job loss. The general recommendation is to save enough to cover 3 to 6 months' worth of living expenses. This might seem like a daunting task, especially if you're just starting out in your career, but it's a crucial step in building a solid financial foundation. Start by setting small, achievable savings goals, such as saving $500 or $1,000, and gradually increase the amount as your financial situation improves. Automating your savings by setting up a direct deposit into a separate savings account can help make this process easier. The key is consistency. Even small, regular contributions can add up over time and provide you with a buffer against financial emergencies. Your 20s is also a time when you may be dealing with significant debt, particularly from student loans and credit cards. Balancing debt repayment with savings can be challenging, but it's essential to tackle high-interest debt, such as credit card balances, as quickly as possible. The interest on these debts can accumulate rapidly, eating into money that could otherwise be saved or invested. Create a debt repayment plan by focusing on paying off the highest interest debts first while making minimum payments on others. At the same time, continue to contribute to your savings, even if it's just a small amount each month. This dual approach helps you manage your debt while still building your financial safety net. Your 20s is the perfect time to establish good financial habits that will serve you throughout your life. This includes creating and sticking to a budget, setting up automatic savings, and avoiding lifestyle inflation. Lifestyle inflation occurs when you increase your spending as your income rises, which can make it difficult to save money. By keeping your expenses in check and prioritizing saving, you'll be setting yourself up for long-term financial success. Developing a habit of budgeting is particularly important. Track your income and expenses to see where your money is going, and identify areas where you can cut back to increase your savings. Tools like budgeting apps can make this process easier and help you stay on track. Remember, the financial habits you develop in your 20s will lay the groundwork for your future financial health. By the time you reach your 30s, your career is likely more established and your income may have increased. This is the time to ramp up your retirement savings. If you're already contributing to a 401k or IRA, consider increasing the percentage of your income that you're saving. Even a 1 to 2% increase can make a significant difference over time, thanks to compound interest. If you haven't started saving for retirement yet, now is the time to prioritize it. Take full advantage of any employer matches and aim to contribute enough to get the full match if possible. Your 30s is often a time when people start thinking about homeownership. If owning a home is one of your goals, you'll need to start saving for a down payment. The traditional recommendation is to save 20% of the home's purchase price, but there are loan programs that allow for lower down payments. However, Putting down less than 20% may mean paying for private mortgage insurance, PMI, which adds to your monthly costs. Start by determining how much house you can afford based on your income, debt, and savings. Then set a savings goal for your down payment and create a plan to reach it. This might mean cutting back on other expenses, picking up a side job, or automating your savings to ensure you're consistently putting money away. Keep in mind that home ownership also comes with additional costs, such as maintenance, repairs, and property taxes, so it's important to budget for these as well. In your 30s, your career may be advancing, which can lead to higher income and more opportunities to save. It's important to leverage this growth to boost your savings and secure your financial future. Take advantage of any salary increases by directing a portion of the extra income into savings, rather than increasing your lifestyle expenses. This is also a good time to evaluate your career trajectory and consider furthering your education or pursuing certifications that could lead to higher paying opportunities. Investing in your career now can pay off in the long run, providing you with the financial stability and flexibility to achieve your savings goals. By the time you reach your 40s, retirement is closer on the horizon, and your savings should reflect that. If you're behind on your retirement savings, consider increasing your contributions to your 401k or IRA. Catch-up contributions are available for those aged 50 and older, but even in your 40s, you can still make significant progress by maximizing your contributions. Additionally, review your investment strategy to ensure it aligns with your retirement goals. If you're not sure where to start, consider consulting a financial advisor who can help you create a plan tailored to your needs. In your 40s, it's important to focus on growing your savings through smart investments. While it's crucial to have a diversified portfolio that balances risk and reward, you may still have enough time before retirement to take on a bit more risk in pursuit of higher returns. Consider a mix of stocks, bonds, and other investment vehicles that align with your risk tolerance and financial goals. Real estate can also be a valuable part of your investment strategy, whether through direct ownership or real estate investment trusts. Additionally, consider investing in your skills and education to enhance your earning potential. The key is to ensure your investments are working for you and helping you reach your long-term savings goals. As you enter your 40s, you may start to encounter significant midlife expenses such as healthcare costs, home renovations, or supporting aging parents. It's important to plan for these expenses and ensure they don't derail your savings goals. Create a budget that accounts for these potential costs and consider setting up a separate savings account for them. Additionally, review your insurance coverage to ensure it's adequate for your needs. Health insurance, life insurance, and disability insurance are all important to protect your financial well-being and ensure you're prepared for unexpected expenses. Taking these steps now can help you avoid financial stress later on and keep you on track toward your long-term savings goals. For those aged 50 and older, the IRS allows additional contributions to retirement accounts. Maximizing these catch-up contributions can significantly boost your retirement savings in the years leading up to retirement. Additionally, consider whether you can increase your savings rate by cutting back on discretionary expenses or working a few more years. The extra time in the workforce can give your savings more time to grow and reduce the number of years you'll need to draw from them in retirement. Your 50s is also a time to focus on paying off major debts, particularly your mortgage. Eliminating these debts before retirement can free up more of your income for savings and reduce your financial burden once you're no longer working. If paying off your mortgage early isn't feasible, consider refinancing to reduce your interest rate or extend your term, which can lower your monthly payments. In addition to your mortgage, focus on paying off any remaining credit card debt, car loans, or other significant liabilities. The goal is to enter retirement with as little debt as possible, so you can live on your retirement savings without the added pressure of debt payments. Your 50s is also an important time to focus on estate planning. This involves creating or updating your will, establishing a trust if necessary, and designating beneficiaries for your accounts. It's important to ensure that your assets will be distributed according to your wishes and that your loved ones will be taken care of. In addition to a will, consider setting up durable powers of attorney for healthcare and finances, which designate someone to make decisions on your behalf if you're unable to do so. Reviewing and updating your estate plan regularly is important, especially after major life events such as marriage, divorce, or the birth of a child. Taking these steps now can help you avoid legal complications later on and ensure your estate is handled according to your wishes. As you enter your 60s, retirement is just around the corner, and it's time to assess your readiness. A common benchmark is to have saved at least 7 to 8 times your annual salary by age 60. However, the exact amount you need will depend on your desired retirement lifestyle, expected expenses, and how long you expect to live in retirement. If you're not sure whether you're on track, consider working with a financial advisor to create a detailed retirement plan. This plan should include an estimate of your retirement expenses, expected income sources, such as Social Security and pensions, and a withdrawal strategy for your savings. It's important to have a clear understanding of how much you'll need to cover your expenses and maintain your desired lifestyle in retirement. As you approach retirement, it's important to start thinking about how you'll transition from saving to withdrawing from your accounts. This includes determining a safe withdrawal rate, which is the percentage of your savings you can withdraw each year without running out of money. A common rule of thumb is the 4% rule, which suggests withdrawing 4% of your retirement savings each year. However, this rule may not be suitable for everyone, depending on your specific circumstances and market conditions. Social Security and pensions can be important sources of income in retirement, and it's important to understand how these benefits fit into your overall retirement plan. For Social Security, you can start taking benefits as early as age 62, but your benefits will be reduced if you start early. Waiting until your full retirement age, which varies depending on your birth year, or even later, can result in higher monthly benefits. One of the biggest challenges in retirement planning is ensuring your savings last for the rest of your life. With life expectancies increasing, it's important to plan for a long retirement and ensure you won't outlive your savings. This may mean adjusting your withdrawal rate, working a few more years, or finding ways to reduce your expenses in retirement. Consider strategies such as delaying Social Security benefits, which can result in higher monthly benefits, or annuitizing a portion of your savings to provide a guaranteed income stream for life. Additionally, continue to monitor your investments and adjust your portfolio as needed to ensure it aligns with your goals and risk tolerance. Saving for the future is a lifelong journey that requires careful planning, discipline, and adaptability. By understanding how much money you need to save at each stage of life, you can create a roadmap that guides you toward financial security and peace of mind. Remember that life is unpredictable, and your financial situation may change over time. The key is to stay flexible and adjust your savings goals as needed to accommodate new circumstances. By continuously reviewing your financial plan, staying informed, and making proactive adjustments, you can stay on track to achieve your long-term savings goals and enjoy a secure and comfortable retirement. No matter where you are in your financial journey, it's never too late to start saving or make improvements to your plan. Take control of your financial future by setting clear goals, developing good savings habits, and seeking professional advice when needed. Your future self will thank you for the efforts you make today to build a solid financial foundation for tomorrow. I hope you found this video helpful. Before you go, don't forget to check out my other videos. See you in the next one.